Good afternoon and welcome to the Market Minute. It's Wednesday, May 11th. I'm George Corrali, and today I'd like to discuss with you the concept of 90% downside days and what they mean for the market. But before I do, let's take a quick look at the Fear and Greed Index. You can see it's recording a reading of 21, which is indicating extreme fear. It's likely to record even lower readings in the days ahead. 1 month ago, we were at a level of 43. In 2002, Paul Desmond of Lowry's Research published a seminal paper titled Identifying Bear Market Bottoms in New Bull Markets. Desmond measured market breadth, namely daily advancing stocks as a percentage of advancing and declining stocks, and two, points gained as a percentage of points gained and lost. The research showed that during significant market declines, panic would manifest itself as one or more days when declining stocks exceeded advancing stocks by a margin of 9-1, and when points lost made up more than 90% of the total points movement. Desmond identified this as a 90% downside day. On May 5th, we recorded our first 90% downside day. The first 90% downside day of this decline to date, right? According to Lowry's historical record shows that 90% downside days don't usually occur as a single incident in a major market decline. We've observed that the very first 90% downside day has typically come when almost half of the down move has already passed. Multiple 90% downside days indicate that a decline is something serious. Declines usually persist until we get a 90% upside day. On May 9th, we recorded our second 90% downside day, a sign that investors may be starting to throw in the towel. This may be the beginning of the capitulation move that we talked about several weeks ago. The average number of 90% downside days at a major market bottom is 5, according to Lowry's. We're at 2 so far. Sometimes we get a decent bounce after a 90% downside day, and then the selling begins once again. Here's a graphic of the June 2016 market bottom. It occurred right after the Brexit vote on June 23rd. The vote led to stock market crashes around the world. Investors lost more than the equivalent of $2 trillion on June 24th, and by June 27th, that amount was $3 trillion. By June 29th, the markets had largely recovered. You can see two 90% downside days immediately followed by two 90% upside days. That turned out to be a durable market bottom. So the bottom must be confirmed by a 90% upside day or two consecutive 80% upside days. The 80% upside days are a bit weaker of a signal, but almost always indicate an intermediate term bottom has been reached. Look, we don't know when a stock market bottom will occur in advance. It's no use trying to predict one. Instead, we can wait for signals to tell us when the bottom is in, and that's what we intend to do. Investors are starting to get really scared, and that's a necessary ingredient of the bottoming process. Remember, big market disruptions bring big opportunities. We're watching market conditions closely. If you have any questions about your portfolio or would like to become more familiar with our investment process, please don't hesitate to contact me. And if you think this type of information would be beneficial to anyone you know, please share this video with them. Thanks for tuning in to the Market Minute. I'm George Corrali. We'll see you back here soon.